This is another concept very important. We've been talking about market structures from the previous video, and this is another video. We're talking about liquidity. So I'm just giving you one of the best course that is free because we're trying to make it in a way that it is in a certain order that you can understand. So liquidity, the king in the market, okay? And you have to know Forex market is a zero-sum game, okay? Do you understand? Yeah, you have to know this. Why? Because for a trader or any institution to buy or sell one currency pair, it is necessary that there is another trader or institution with an opposite position. Okay. And if the smart money or the banks want to buy a currency pair, they will need sellers in the market. Okay. The existing facility to take this position in the market is called liquidity. And therefore, without liquidity, the market cannot move. And therefore, we need liquidity. That's why I've told you liquidity is the king. So what is especially liquidity? What is liquidity, by the way? Liquidity is just what we call stop losses. So that's why I'm telling you, sometimes if you're not aware of the smart money concept, you can end up being a liquidity in the market. You can end up being a source of liquidity in the market. Why? Because they are going to use your stop losses, and therefore you're going to lose money that is going to be used to push the market. Okay. Okay. This is very important. So this is stop losses are what we call smart. These are money. These are liquidities. Okay. You understand? That's why these guys have to make sure they activate your stop losses, but also pending orders can be used as liquidity. Okay, this is very important. So we have some types of liquidity. We have buy stop liquidity, we have sell stops liquidity, and other liquidity. And in this video, let's look at this first part. Let's look at these two types of liquidity because these are the liquidity which confuses people, and I'm going to show you their meaning. So the first one is buy stop liquidity. Buy stop liquidity. This is originated by stop losses of sell orders. Okay. After the buy stop liquidity is taken, the market reverses to the downside because banks use the buy side liquidity to press sell orders. So they lie to you like you have to take a buy entry there, and when you take it, you're out of the market. Okay, and when you're talking about buy side liquidity, you're talking about some highs, which can be a previous monthly, a previous weekly, previous daily, high of the day, swing high, and little resistance, which is also another type of liquidity called ranging liquidity, equal highs. Equal highs. When you have equal highs, that means you have a liquidity. For example, here you can see the market was going upward, and these guys made like a cheating, something like they had to cheat at little traders like we going up. Why? Because little traders trade on what you call breakout. Okay, so when the market broke here, they saw the market was going upward. You can see the market came down. Why? Because they took stop losses here above. That is what you call buy side liquidity. Stop losses were taken, and people lost their trades, and those stop losses were used as liquidity to push the market downward. Likewise, sometimes you can find equal highs. That is, this is a little resistance. Most people, little traders believe because it is a little resistance. That means if it is broken, then we have to keep buying. So they break it, and you can see some people will start buying so that we can have a lot of stop losses there. And what the market does is comes down and take out all those stop losses and become liquidity. So it can be a previous month high depending with the time frame. Okay, so when you're using a monthly time frame, that means we're going to have previous month high when it is taken, as you can see here. Okay, this is monthly time frame. It was taken here. This means buy side liquidity was taken here. So you can just use two candles when you're dealing with monthly, and you can just go to the lower time frame and see something like this one showing you that liquidity was taken, especially when you just have a week. Understand this. When you have a week, if a wick break this high, the previous high, that means, and it went up coming down, that means it went up to take some liquidities. Yeah. So that is one of the reason. As you can see here also, previous week, you can see we had this black candle. You can see this red one went up and took out. This shows that it took some liquidity there, took some liquidity there, took some liquidity there. And if it has taken liquidity, we don't expect the market to keep going just upward. That's why in this kind of structures is where we always draw our order blocks. Why? Because liquidity has been taken already. So we don't expect the market to keep going up. We expect the market to leave us. So make sure you stick here so that I can teach you on how to draw order blocks. But for the previous day also, it is in the time frame, daily time frame. So when you go to the daily time frame, in order to understand if the market has taken some liquidity, buy side liquidity, just wait for the market to come above. It's just a week. You don't need to see the body. If you see the body, that is not liquidity grab, okay? Because this is what we call liquidity grab. Only we need to see wicks going up. Here also you can see it went up. So that is the easiest way you can master. High of the day, you have to go to the high of the day. Always I tell people, make sure you go to what we call 15 minutes. That is nice. 15 minutes, as you can see here, 15 minutes. This was what they took out liquidity. They took out liquidity, which were here above high of the day liquidity, and it started going downward. As you can see, order high here, market went up, took it, and it started going down. So this is not difficult. This is very, very easy. It is not something that is difficult, and you can just master it. So this is what we call buy side liquidity. So let's talk about sell stops liquidity. This is originated by stop losses of buy orders. Okay. After the stop losses is taken, the market reverses to the upside because banks use the stop losses, the sell stops liquidity to place buy orders. Okay, so they use buy side liquidity to place sell orders. They use sell stops liquidity to place buy orders. The same previous month's law, previous week law, previous day law, depending. So these are the same thing. Something that is different here is just the time frame. Okay, where do you see them? In which time frame? But they mean the same thing except for the equal laws, the little support. Okay, so you can see here we have equal laws. We have some liquidities. I taught you when you have equal laws, that means you have liquidity here. Some people believe this is the support, and therefore, when it is broken, the market must keep going down, and it keeps going down for a moment before more people started selling, before these guys buy by just taking out their stop losses. Likewise here also. Okay, so you can see here we have a previous month's law, and this is monthly time frame. Monthly time frame, you can see why, because you can see the market was coming and black. This one on by weeks. Here also only by weeks, only by weeks, only by weeks. And this confirms that the market will keep pushing up, keep pushing up. Okay, this is very important. Previous day law, you can see also, I have shown you. So these are just law of the day in 15 minutes time frame. You can see the market went down here. It means it came down to take liquidity. And in order to confirm if it made a liquidity land, you have to look at the momentum. Okay, when the momentum is very high, that means it took some liquidity. Okay, this is very important. That's why you can see most of the time it is going with very high momentum. So this is equal loss in the little market. You can see what happened here. The market went down, and what it did, or it is swept out liquidity or equal loss, which showed that liquidity has been taken, sell side liquidity has been taken and been used to buy. Those big guys use those sell side liquidity to buy in the market, to push the market upward. Okay, understood? Okay. Yeah, this is very, very, very unique. This is very, very important. And you have to know this. It will help you to master the market. Okay. So there is a concept called stop hunting. Okay. And this is stop hunting is what we call manipulation of liquidity. Okay. So this is manipulation of what we call liquidity. Okay, now and stop hunting is very important. This is the process where these guys they hunt you, they hunt your stop losses by using some little concept like support and resistance and trend lines because most people use those. Okay, so it is always a false breakout above or below the zone where there is liquidity. So I'm going to show you very soon. Here you can see. Okay, so we have buy side liquidity here, and here you can see the market block here. It blocked here so that it could hunt some stop losses here. It was not going to keep going upward. No, it just wanted some people to enter to start buying before those stop losses are hunted and taken out. But also here you can see, but also here you can see. So it is always showing that it is a long direction before they take out your liquidity. So every trader must be aware of determining what we call stop hunt. You have to know this is a stop hunt so that you cannot just enter. For example, if you cannot understand this is a stop hunt, you can enter buying here and lose your money. But also here, you have to understand. But also we have what we call high impact news. These are the news which will help you to understand. But this is, let's leave this one. We're going to talk in the end about fundamental analysis. So let's talk first about what we call analytical. What we call technical analysis. So in this fourth chapter, we will talk about order blocks. Don't miss out the next video. Have a nice day, my people. Love you all. Make sure you subscribe, like, and comment. God bless.